Welcome back to the Deep Dive. Today, we are heading to Nepal for a fascinating look at a high-growth market that, well, maybe few outside the region fully appreciate.
That's right. We've got this incredibly detailed investment report here. And it's interesting because it doesn't just look at real estate or finance, in isolation.
No, it actually stitches them together
Yeah,
into this compelling hybrid model involving agribusiness.
exactly. And look, this is more than just raw data. It's really a manual for understanding structural opportunity. So our mission today is pretty clear.
Okay.
We need to cut through the complexity of this Nepal real estate and hybrid agribusiness investment report to extract the most viable path forward and really focus on the policy environment that forces capital toward productive growth.
And the scale we're talking about here is just, well, immense. As of right now, 2025, this market is valued at US $453.91 billion.
Huge number.
It's a huge foundation.
It is, and the trajectory is strong.
Yeah.
We're looking at a steady 4.8% compound annual growth rate. That's projected to push the total market value to, US $600 billion by 2030.
Wow. But here's the key insight, I think. Much of this growth, it's trapped in speculation. So the central thesis of the report is really how to build a model that, avoids that trap.
Right, and that specific model is this unique combination, a multi-purpose cooperative bank paired with a dedicated dairy farm operation, designed as an integrated financial and production structure.
Exactly. It's profitable, and crucially, it's policy compliant, which is key. The total initial capital requirement for this specific structure is MPR 2.5 crore.
Okay, let's pause on that number for a second because for listeners outside the Nepali context, it's useful to get a sense of scale. NPR 2.5 crore, that's 25 million Nepali rupees.
Right.
Or roughly 190,000 US dollars, give or take.
Right.
And that breaks down 1.5 crore for the cooperative bank formation and 1 crore dedicated to getting the dairy operation off the ground.
Yeah, so it's really a micro investment structure, relatively speaking, designed to tackle a macro problem. Now, to really understand the market's current volatility, I think we need to look back a bit. Where does property ownership even come from in Nepal?
Well, the land systems are ancient. You've got things dating back centuries like the Guthi system in the Kathmandu Valley, which managed community and religious lands.
Okay.
Those systems define the culture, sure, but the modern reality that really stems from the Rana dynasty. They formalized property plotting with the 1923 Kitta system.
Right.
But the fascinating part is how external money then just supercharged this localized system. Post-2003, we saw land prices just explode,
Explode how much?
rising an incredible 300% in many regions.
300%. I mean, that is the very definition of a speculative bubble. What was feeding that?
Remittances, primarily. Money flowing back home from Nepali citizens working abroad. It needed a safe, tangible place to land,
Sure.
And real estate was seen as the default, the best asset. It just created this enormous market distortion. I remember reading about one case, mid-2000s, a single small plot in a desirable area changed hands 3 times in less than 6 months, quadrupled its value, purely based on rumor and cash injection.
Incredible. And that initial wave, was it affected by the 2015 earthquake?
Absolutely. That compounded things. It forced a lot of investment and reconstruction activity to shift away from the heavily damaged urban centers toward rural and semi-urban areas.
Okay.
That pivot really set the stage for some of the opportunities we're seeing today.
And this isn't some marginal player in the economy either, right?
Yeah.
Real estate's contribution is significant.
Oh, definitely. It currently contributes 8.7% to Nepal's GDP. Employs millions informally, too.
So if we dive into the current dynamics, like right now, 2025, that residential segment is just dominant.
Overwhelmingly. 86% of the total market value, that's US $390.33 billion, is tied up in housing.
Wow.
And urbanization growing at 6.4% is the big structural tailwind behind that.
But that growth is hitting some friction now.
It is, yeah. High interest rates have caused a noticeable dip in activity in 2024 and into 2025. It really reminds us that this isn't just one single national market. You have to look provincially if you're serious about investing.
Okay, let's use that provincial data then. We need to talk about price per anna. That's the traditional land measure, right? About 32 square meters.
Exactly. So take Bagmati province. That includes Kathmandu and Lalitpur. It's the engine room. Highest density, highest prices.
Oh, my.
Ranging from 500,000 up to 2 million plus NPR per anna. Per anna. And urban apartments there have surged 20%. That's the speculative hot zone.
But wait, if 86% of the market is concentrated in residential areas like Bagmati, how much harder does that make it to find affordable land for commercial use, or, more importantly for this project, agricultural use.
That's the central challenge, exactly. Now, contrast Bagmati with, say, Karnali province, places like Sirkut and Jumla.
Okay.
Lowest activity. Prices plummet to maybe 50,000 to 200,000 NPR per annum.
Wow, that's a huge difference, almost tenfold.
It is.
So Karnali might not be the spot for our dairy farm, but that low price, low activity, it immediately suggests other strategies, doesn't it?
Absolutely. The report flags Karnali's future potential for things like eco-resorts or adventure tourism, non-residential investment that future policies might actually favor.
Right.
However, for our hybrid model, the focus is more on areas like Lumbini and Chitwan.
Okay.
These areas are explicitly identified in the sources as key locations for farms and factories. They offer that perfect balance of land availability, transport access, and, importantly, agricultural history.
Okay, let's talk about the flaws.
Yeah.
The structural issues that this high growth kind of masks. We mentioned the 300% speculation.
Right, but that's just one piece.
What else is there?
Well, you've got pervasive issues with transactions being handled informally, off the books. And the squatting issue is real. It affects maybe 7% to 10% of urban areas. But I think the biggest structural flaw really is affordability.
How bad is it?
75%. 3/4 of the Nepali population cannot afford to buy property right now.
Wow.
That statistic just highlights the deep social imbalance that's been created by this remittance-fueled speculation.
So if the government and the central bank want stability, what are they doing? What policy tools are they using to, rein in that runaway speculation?
They're hitting it from multiple angles. There are anti-speculation taxes being discussed or implemented. There's a major push for digitization, trying to bring those informal deals onto the formal record.
Okay.
Probably the most important mechanism for a discussion is the Nepal Rashtra Bank, the NRB, the central bank. They've imposed strict caps on real estate loans.
Tell us about that cap. Why does that matter so much to the whole system?
Okay, so commercial banks are now limited. They can only hold a maximum of 25% of their total loan portfolio in real estate.
25%.
That's it. And this is a massive shift. It means these established commercial banks are now forced to divert capital away from real estate. They're desperately searching for other profitable, compliant investment sectors.
Well, okay. So that creates a vacuum.
Exactly. A vacuum in the market that smaller, more nimble, policy-compliant instruments like our hybrid model can potentially fill.
So the NRB cap forces commercial banks out.
Yeah.
But where is this capital supposed to go? The legal framework must be key here. Things like the Lands Act of 1964, setting ownership limits, and the Civil Code from 2017 governing transactions.
Precisely. And looking ahead, that U.S. $600 billion projection for 2030, it isn't just wishful thinking. It's kind of hardwired into concrete plans.
Right. We're talking infrastructure, new highways, airports coming online, driving new demand, new connectivity.
Yes. And plus, there's a clear shift towards sustainability. You're seeing smart homes, eco-apartments gaining market traction, and the government is basically guaranteeing some baseline demand through the National Shelter Policy. They're targeting, I think, 40,000 annual housing units. So all these policies are sort of converging to stabilize the sector, which makes a strategic, policy-aligned investment structure like this hybrid model incredibly appealing.
Okay, that brings us right back to the central idea then. The hybrid model.
Yeah.
If the central bank is forcing capital away from speculative real estate, banks need profitable, compliant places to put that money.
Exactly.
And that's where the cooperative bank paired with the dairy farm comes in.
Yeah, this integrated structure is really designed for efficiency and compliance. The cooperative bank is the financial anchor. It collects deposits, paying relatively low interest, maybe 4% to 6%, and then it issues loans at higher rates, say 8% to 12%.
Standard banking, basically.
Pretty much. But the genius lies in the legal requirement for deploying a portion of that capital.
Which is?
The Cooperative Act 2074, and this is backed by NRB directives from just this year, 2024. It mandates that 50% or more, half of cooperative funds, must be invested in designated productive sectors.
Must be. Not can be.
Must be. It's not a suggestion. It's a policy stick, basically, forcing capital out of speculative urban land and into essential productive capacity, like agriculture.
Oh, okay. So the cooperative takes what, 20% to 30% of its funds, which is well within that 50% mandate?
Right.
And invests them directly into the dairy operation. The dairy farm then becomes the engine of production, aiming for a pretty robust 500 to 1,000 liters of milk per day.
That's the target, yeah. And Integrating agriculture for feed-to-control input costs is part of the plan, too.
So it capitalizes perfectly on the existing productive economy. Agriculture is already about 25% of Nepal's GDP.
Roughly, yeah.
And the dairy sector specifically is growing at a stable 4% or so.
Exactly. So this model provides a regulated, potentially high-return pathway for that cooperative capital to meet its legal investment obligation.
And the real estate component here isn't the speculative urban plotting we talked about earlier. It's functional, productive.
Correct. The real estate link is sort of twofold. First, the land acquisition itself for the farms and those agricultural hubs like Chitwan or Lumbini.
Right. And second, the cooperative can use its specialized knowledge to finance other ag-related real estate loans. So it's connecting rural property development directly to the supply chain.
Okay, let's talk brass tacks then. We've established the strategy, the logic, but does it actually pay? The report projects an internal rate of return, an IRR, of 16.4%.
That is the crucial number. Over the 5-year projection detailed in the report, the cumulative pre-tax profit lands at NPR 39.99 million, so just shy of 4 crore.
Almost 4 crore.
This model is designed to generate significant, consistent earnings.
Okay, wait. 16.4% IRR sounds fantastic, obviously. But given the market volatility we just discussed, 300% price swings in the past, the high interest rates now, maybe some political risk entering a developing market.
Yeah.
How reliable is that projection?
Yeah.
Is 16.4% really enough to offset that kind of risk profile?
That's a highly critical question, absolutely. Yeah. And the reason the 16.4% is considered viable, I think, is precisely because the model is somewhat shielded by its policy compliance.
It exceeds the typical cost of capital in the region, which sits somewhere between 8% and 12%. So by staying policy compliant, the cooperative potentially de-risks its operations significantly compared to, say, a traditional speculative real estate firm.
Right.
When your returns are outpacing your borrowing costs by, 4 to 8 percentage points, you have a much more defensible structure.
Okay. And beyond the IR, are there other key financial metrics that sort of indicate stability here?
Yeah, the strength is also in the margins. The 5-year average net margin is projected at a very healthy 22.4%.
22%.
And the return on investment, the ROI, averages 32.0%. These ratios demonstrate that the productive sector side of the business isn't supposed to be a weak link. It's actually designed as a high-performance asset.
And what about the risk analysis? I mean, what if milk prices drop or competition heats up?
Well, the sensitivity test provides some assurance there. Even in a deliberately pessimistic scenario, which is detailed in the report, the model still projects hitting the break-even point by year 3.
Year 3 break-even, even in a pessimistic case.
Yeah, that kind of built-in resilience is pretty essential for an investor looking at a dynamic market like Nepal.
This really has been a deep dive then, starting with ancient land tenure, charting through post-earthquake reconstruction, modern central banking rules, all culminating in this financially engineered agricultural structure that's projected to generate a 16.4% IRR.
Yeah, the underlying story here is really the tension between old capital flows like remittances flooding into land and these new policy demands. We're witnessing this intersection where infrastructure development is fueling demand, while regulatory mandates are simultaneously forcing capital away from purely speculative ventures and pushing it towards viable, productive structures like this one.
And that leads perfectly to our final provocative thought for you, the listener, to maybe mull over as you process all this data. We learned that remittances fund 33% of real estate purchases in Nepal, directly injecting foreign capital into property speculation, which, as we said, drives up prices for the 75% who can't afford it. Now, juxtapose that with the mandatory NRB directive forcing cooperatives to invest 50% or more of their funds in local productive sectors, like this dairy operation.
Yeah, the tension is clear.
So the question is, how will future national policy balance that desire for foreign-funded growth, that remittance cash with a pressing mandated need to boost local productive capacity? That regulatory tension and the strategic investment structures designed to navigate and potentially profit from it will undoubtedly define the Nepali market heading towards 2030.